Everyone keeps telling you the market's fine. But under the surface, one of the biggest ticking time bombs in 2025 is hiding inside your portfolio. But the question is, which one? Is it the US Treasuries? The so-called safest asset? Tech stocks priced like they'll colonize Mars next Tuesday? Or real estate investment trusts struggling to survive in a world of high rates? Forget the polite analyst talk. Today, we're going straight at it. We're digging into which asset is the most dangerous to put your money into right now, and how not to end up the bag holder when it blows up. So buckle up and let's dive into it. Before we pick a most dangerous, let's set the backdrop. In 2025, markets are dealing with a cocktail of rising interest rates, inflation stickiness, geopolitical uncertainty, and stretched valuations in multiple sectors. Treasuries? Yields are bouncing like a ping-pong ball. The New York Fed just warned that short positions in Treasury futures are sitting above $1 trillion. Translation: if something snaps, a wave of unwinds could slam the entire system. Meanwhile, real estate investment trusts are showing mixed signals. Some sectors like telecom or healthcare are holding up, but office, retail, and general commercial real estate face headwinds from vacancy, oversupply, and high rates. And tech? It's under pressure. The same AI boom that lifted many names has increased expectations, making them more vulnerable to disappointment. A recent academic model argues many AI-centric firms are priced far ahead of what their actual capabilities justify. So, you've got rising rates squeezing bonds, weaker fundamentals in real estate, and sky-high expectations baked into tech. Which of those is most dangerous? Let's break them down. Let's start with Treasuries, often the default safe bet. But in 2025, they carry their own sets of risks. First, interest rate risk. Bonds move in the opposite direction of rates. When interest rates rise, bond prices fall, and the longer the maturity, the harder they fall. That's why long-dated Treasuries are considered especially risky. Even though some analysts think yields will hover in the 4% to 5% range, that's still a wide enough band for painful swings if the Fed surprises or inflation flares up again. Second, liquidity stress. The Treasury market is the biggest bond market in the world, and it's heavily used for hedging, leverage trades, and all kinds of financial plumbing. That works fine, until everyone tries to exit at the same time. If traders are forced to unwind positions in a hurry, it can set off a chain reaction that rattles the whole system. Third, real yield erosion. On paper, a 4% or 5% yield might look decent. But once you factor in inflation and ballooning fiscal deficits, that safe return doesn't look as safe anymore. Investors are starting to question the long-term trajectory of US debt. And that uncertainty adds another layer of risk most people don't price in. Now, to be fair, there's another side to the story. Compared to just a few years ago, bond yields actually look pretty attractive. And if equities take a big hit, Treasuries could still serve as a stabilizer in a diversified portfolio. So, they're not all bad, they're just not bulletproof. So Treasuries aren't bulletproof, but are they really the most dangerous? Let's shift over to real estate investment trusts. On the surface, some real estate investment trusts look solid. Data centers, telecom towers, and healthcare facilities are still in demand. AI infrastructure keeps growing, and aging populations keep healthcare real estate busy. But beyond those niches, a lot of REITs are struggling. Office vacancies are still stubbornly high. In housing, oversupply in some markets is pushing rents down. That squeeze puts real pressure on income. Valuations don't help either. Many REITs look expensive when you compare their dividends to the risks from high rates and credit stress. And the gap between what public REITs trade for and what private real estate is valued at hasn't really closed. Add in the fact that the REIT index has been swinging wildly this year, yet is only up about 1.8%, and the so-called safe yield starts to look more like a minefield. Now, let's talk about tech. Probably the most obvious, but also the most tempting danger zone. A handful of mega-cap tech names are carrying the market right now. In fact, just 5 stocks are responsible for half of the S&P 500's gains in 2025. That concentration is risky. Valuations are sky-high, pricing in not just strong growth, but almost science fiction levels of AI breakthroughs and endless multiple expansion. If reality doesn't live up to the hype, or if expectations simply cool down, the downside could be brutal. Some of these AI-native companies are being valued more on dreams of future capability than on the profits they're actually making today. And here's the pattern. When markets turn, tech usually gets hit first, and it often gets hit the hardest because it's so sentiment-driven. The upside is huge, but so is the embedded downside. So after laying it all out, which asset really jumps out as the most dangerous in 2025? The truth is, there isn't a single clear-cut villain, but each comes with its own landmines. Let's walk through it. First up, long-dated Treasuries. On paper, they're safe, backed by the US government. But in practice, they can be anything but safe. The problem is duration risk. They're hypersensitive to even small moves in interest rates. If yields jump 0.5%, you can watch the value of a 30-year Treasury tumble hard. Add in the fact that the Treasury market is packed with leveraged trades, and a sudden shock can snowball into forced selling and real pain. What's marketed as stability can actually turn into volatility. Then you've got real estate investment trusts, or REITs. These are supposed to be income machines, right? But in today's environment, that income is getting squeezed. Higher vacancy rates, pressure on rents, and financing costs that have gone up dramatically all chip away at margins. Meanwhile, valuations in some areas don't match the actual risk on the ground. Real estate isn't like a stock you can just reprice overnight. It's slow, it's lumpy, and when conditions shift, cracks show fast. That makes REITs tricky if you're hoping for something rock solid. But if I had to circle the biggest danger, it's probably overvalued tech. Why? Because so much of its strength right now isn't just about fundamentals, it's about the story. If the narrative around AI, cloud, or edge computing starts to stumble, valuations could unravel fast. And with tech, the volatility is already built in, so when it drops, it doesn't just dip, it cascades. That said, risk always depends on you. Your time horizon, your tolerance, and how much exposure you actually have. If you're overloaded in any of these categories, that's where your real vulnerability lies. So, if you forced me to pick the single biggest landmine today, I'd call out overvalued tech, because the danger isn't only in the numbers, it's in the narrative propping them up. But here's the hedge. None of these are safe if you lean in too hard without respecting the downside. All right, so what can you actually do instead of just sitting there watching your portfolio blow up? Let's talk practical steps. First, trim the excess. If you're overloaded on speculative tech names, companies with sky-high valuations but barely any earnings, it might be time to cut back. Keep exposure to quality, but lighten up on the lottery tickets. Second, rethink your bond positioning. Long-dated treasuries might feel safe, but they're super sensitive to rate moves. You can lower that risk by sticking with shorter duration bonds or floating rate instruments. That way, you're not a hostage to every Fed announcement. Third, be selective with REITs. Not all real estate is created equal. Office and retail are struggling, but data centers, healthcare facilities, and properties tied to AI infrastructure have real tailwinds behind them. Pick your spots. Don't just buy the whole sector blindly. Fourth, use hedges and diversify. That could mean adding a little gold, inflation-protected securities, or even some emerging market exposure. Or, if you're comfortable, using hedging strategies like options to balance out risk. The point is, don't have all your chips stacked in one place. Fifth, stay disciplined on valuations. Don't get caught chasing growth for the sake of a headline. Look for companies with actual earnings, healthy margins, and a path to keep compounding, not just a flashy story. And finally, maintain cash. Having some dry powder on the side gives you flexibility. When markets wobble and assets go on sale, you won't be forced to panic. You'll be in a position to take advantage. That's how you move from being a sitting duck to actually steering the ship, no matter which of these dangerous assets cracks first. Overall, there's no perfect answer. But in 2025, each of Treasuries, real estate investment trusts, and tech carries outsized risks. Tech may carry the sharpest sword, REITs, the slow bleed, Treasuries the shock. The real trick is knowing which risk you can live with and preparing for when things go sideways. So guys, which of these three do you fear most? And how are you positioning your portfolio? If you found this useful, please do well to give us a thumbs up and hit the subscribe button for more.